Did you know that while most people panic, a few are quietly getting rich? In every crisis, hidden opportunities appear. Undervalued assets, promising projects overlooked, and niches that only those with vision can see. The question is, will you run with the herd or act strategically? If you're between 20 and 35 years old, interested in finance, crypto, alternative investments, or thinking about starting a business even when the world seems to be falling apart, this video is for you. In the next few minutes, I'm going to show you 3 hidden opportunities that only appear when everything seems to be collapsing, and how you can take advantage of them now before it's too late. Stick around until the end. This could be the key to your next big win. Have you ever felt like you got into a stock too late, when everyone else has already made their profit and you just got the leftovers? That doesn't happen because you're unlucky. It happens because you're seeing the opportunities after they've passed. While most people chase what's already gone up, strategic investors are buying what's still invisible, usually in the middle of chaos. Every crisis creates panic, but what most people forget is that panic also creates distortions. And inside those distortions lie some of the biggest opportunities in the market. When everything crashes, undervalued, misunderstood, or ignored assets appear with explosive upside potential, but only for those who can spot them before the crowd does. This video is for those of you who already invest, who understand the basics, but still get the timing wrong. You buy too late, sell too early, or overlook what had real potential to multiply your capital with less risk and more consistency. To help you fix that, I'm going to show you 3 types of stocks that historically skyrocket after moments of chaos. And more importantly, how to spot them before the market starts talking about them. Before we get into those 3 types, let's understand why crises are such fertile ground for opportunity. Financial markets move in emotional cycles. Optimism, euphoria, decline, fear, panic, disbelief, and only then comes recovery. Most people buy in euphoria and sell in fear. But the big investors, the ones who actually make money, do the exact opposite. They buy in panic and sell in optimism. What does that mean? That the moment of greatest fear is almost always the moment of greatest opportunity. The problem is, when everyone else is panicking, your brain wants to run too. And that's when you need to learn how to look at the data coldly and rationally. The most common mistake among intermediate investors is following the herd. They wait for a stock to show up in the news, on social media, in analysts' recommendations. But by the time that happens, the price is already gone. The information is already priced in. The market isn't fair. It's fast. If you wait for confirmation, you're already too late. Want an example? Take IRB in 2020. After a governance scandal, the stock plummeted. The market turned its back. But a few months later, with a new management team, improved financials, and institutional investors stepping in, the stock shot up over 100% in a short time. Those who bought at the bottom, when it seemed insane, made a profit. Those who waited for the headlines only watched from the sidelines. Now that you understand the why, let's look at the 3 types of stocks that most often explode after chaos, and how to spot them early. The first type is cyclical recovery stocks. These belong to sectors that are directly impacted during crises, but rebound strongly when the economy recovers. Think airlines, tourism, shopping centers, construction companies. When the world slows down, these companies are the first to drop. But when confidence returns, their recovery is intense. How do you identify them? Watch the economic cycle. Look at their historical financials. A company that survived other crises and has enough cash to endure reduced revenue for a few quarters is a strong candidate. You can use indicators like historical EBITDA, controlled leverage, and trading volume recovery. The key is to enter when nobody wants to look and exit when everyone's chasing. The second type is oversold stocks with strong fundamentals. These are companies that fell with their sector but are still financially healthy. In these cases, the drop was caused by general fear, not actual weakness. A classic example is WEG during crisis periods, a solid company with recurring profits that occasionally gets sold off along with other industrial names. The price drops, but the fundamentals remain solid. How do you identify these opportunities? Use the RSI, Relative Strength Index. Values under 30 indicate overselling. Combine that with support level analysis and consistent profit growth over the last few quarters. If the fundamentals are intact and the price is near technical support, that stock might be ready for repricing. The third type is ignored small caps with high asymmetry. This one is bolder, but much more lucrative. These are small companies, rarely covered by analysts, but solving real problems with scalable business models. They suffer harder during downturns because of low liquidity and market trust. But when capital flows return, these stocks can multiply 2x, 3x, even 5x in a matter of months. You find these gems where no one is looking. How? Use platforms like TC Matrix, Fundamentai, or Status Invest. Set filters for low debt, revenue growth, above average ROE, insider buying, and low analyst coverage. If the company has an expansion plan, innovation, and operates in a promising niche, stay alert. It could be an overlooked gold mine. Now you might be wondering, okay, but how do I find these stocks before the market does? Here's where the strategy comes in. First, develop the habit of looking where no one else is looking. The biggest opportunities don't come from viral videos. They come from quiet data. Set alerts for stocks that dropped over 30% in 3 months or with abnormal volume increases. See who's buying. If institutions are stepping in while retail investors are fleeing, that's a strong signal. Use tools that filter for low valuation multiples combined with profit growth. Look for companies repurchasing their own shares or whose executives are increasing their holdings. These are signs of hidden value that the broader market hasn't noticed yet. And more important than any tool, have analytical discipline. Build a routine. Every week, analyze 5 off-the-radar companies. Read their reports, study their press releases. You'll begin to train your eye. And when the market finally looks their way, you'll already be in position. Let's recap. Cyclical recovery stocks. For those who understand the cycle and are patient. Oversold stocks with strong fundamentals. For those who see past fear. Asymmetric small caps. For those who spot opportunity before the hype. These 3 categories tend to appear when the market is afraid, and those who act strategically in those moments capture the biggest returns with the least relative risk. This isn't luck, it's reading, method, and early execution. Drop a comment below. I want to act before the market, and send this video to that friend who only invests when it's already trending. Maybe he just needs a push to change his mindset. Subscribe to the channel for more technical, direct, and no BS content. Here we teach you to think like winners do, because profits don't come from following the flow. They come from knowing where it's going before everyone else.